Let me paint you a picture. You're at a family dinner, could be Thanksgiving, could be a birthday, doesn't matter. And someone at the table, usually the uncle or the older cousin who just refinanced their house, leans back in his chair and says it. You know it's coming the second he opens his mouth. Real estate is the only real investment. Stocks, those can crash overnight. But land is forever. They're not making any more of it. And everyone around the table nods. Forks clink, someone passes the bread, and you sit there thinking, is that actually true, or is it just something people say? Or maybe it's the opposite. Maybe you've got a friend, probably works in tech, definitely has a Robinhood account, and every time you see him, he's talking about dollar cost averaging and compounding returns and how Warren Buffett said to just buy the S&P 500 and leave it alone. And part of you wonders, is he right? Is the answer that simple? Here's the uncomfortable truth. Neither the uncle nor the tech bro is actually running the math. They're both repeating things they heard, believed, and never fully tested against reality. And that's exactly what we're doing today. We're running the real math. No bias, no agenda, no real estate always wins or stocks are the only way narrative. Just the actual numbers, with all the things most videos conveniently leave out. Because here's what I keep seeing. People are making the biggest financial decision of their lives, where to put their money for the next 10, 20, 30 years, based on vibes, based on what sounds smart at the dinner table, based on YouTube thumbnails. And then they wonder why they're not getting ahead the way they expected. So stick with me, because by the end of this, you're going to have a framework that actually helps you decide, not based on what sounds cool, but based on what actually works for your specific situation. Let's get into it. Okay, so first, let's acknowledge something. This debate has been going on for decades, and the reason it's never really been settled is because both sides cherry-pick their numbers. Real estate people compare their property appreciation to a bad decade in the stock market. Stock market people ignore leverage and compare cash returns without accounting for what a mortgage actually does. Nobody's comparing apples to apples, so let's actually do that. We're going to compare two people. Let's call them Alex and Jordan. Same starting point, same amount of money, same 20-year window. One invests in real estate, one invests in stocks. And we're going to track every dollar, the gains, the costs, the taxes, the headaches, all of it. Alex has $60,000 saved. She uses it as a 20% down payment on a $300,000 rental property. She gets a 30-year mortgage at around 7%, which is, as of 2024, a realistic number, not a fantasy from 2020. She rents the property out and manages it herself. Jordan also has $60,000. He puts it all into a low-cost S&P 500 index fund. He sets up automatic contributions and doesn't touch it for 20 years. Who wins? Here's the thing. The answer is genuinely more complicated than you think, and the complications are where the real lessons live. Let's start with real estate, because I think it gets misunderstood the most. When people talk about real estate returns, the number they almost always quote is price appreciation. Home values have gone up an average of X% per year. And that's true. Nationally, home prices have appreciated roughly 4% annually on average over the long run, according to data from the Federal Housing Finance Agency. Some markets better, some worse, but 4% is a reasonable baseline. So if Alex's $300,000 house appreciates at 4% per year for 20 years, what does it become? Run the compound math and you land at just under $658,000. Her house nearly doubled. That sounds incredible, right? But wait, here's where the real estate calculation gets complicated in ways most people never account for. First, the mortgage. At 7% on a $240,000 loan, Alex's monthly payment is roughly $1,597 just in principal and interest. That's $19,164 a year in mortgage payments. Over 20 years, she pays about $383,000 toward the loan. Some of that builds equity, yes, but a huge chunk of it, especially in the early years, is pure interest. In the first year alone, she pays over $16,000 in interest on that mortgage. The bank is getting paid before she gets anything. Second, property taxes. National average property tax rate is about 1.1% of assessed value, according to the Tax Foundation. On a $300,000 house, that's $3,300 a year, which will increase as the home's value rises. Over 20 years, conservatively, she's paying somewhere in the range of $75,000 to $90,000 in property taxes alone. Third, maintenance and repairs. Every real estate investor and financial planner worth talking to will tell you, budget 1% of the home's value per year for maintenance. On a $300,000 property, that's $3,000 a year. In reality, it's lumpy. Some years you spend almost nothing, then the HVAC dies or the roof needs replacing, and you're writing a $12,000 check. But $3,000 a year is a conservative average. Over 20 years, another $60,000 minimum. Fourth, vacancy and management. Alex is managing herself, which saves the typical 8 to 10% property management fee. But she will have vacancy. Even well-managed rentals average around 5 to 8% annual vacancy rate. On a property renting for $1,800 a month, a 6% vacancy rate costs her about $1,296 a year in lost rent. Fifth, insurance. Landlord insurance costs more than regular homeowners insurance. Expect $1,200 to $2,000 a year on a property this size. So let's add it up on the cost side for Alex, conservatively over 20 years. Mortgage interest, not principal, just the interest, roughly $200,000. Property taxes, $80,000. Maintenance, $60,000. Insurance, $30,000. Vacancy losses, $25,000. That's nearly $400,000 in total expenses over 20 years, not including the original down payment. Now, critically, she's also collecting rent. Let's say she starts at $1,800 a month and raises it 3% per year, which is reasonable. Over 20 years, her total rental income comes to approximately $580,000. So, when you subtract expenses from rental income, $580,000 in rent minus $395,000 in operating costs equals about $185,000 in net cash flow. Add that to the equity she's built. By year 20, assuming the 4% appreciation, the house is worth around $658,000, and she's paid off a significant chunk of the mortgage. Let's say she has roughly $450,000 in equity. Add her $185,000 in cash flow, and you're looking at a total return in the neighborhood of $635,000 over 20 years on an initial $60,000 investment. That's an extraordinary return, multiple on invested capital of over 10x, and that is the real power of real estate. Leverage. She controlled a $300,000 asset with $60,000. She got appreciation on the full $300,000 while only putting $60,000 in. No other investment lets you do that legally at scale with a fixed rate loan. But before you run out and buy a rental property, hold on, we haven't looked at Jordan's side yet. Jordan takes his $60,000 and puts it into an S&P 500 index fund. That's it. No property tax, no leaky roof, no 2 a.m. calls from tenants, no mortgage. Just money in an index fund. What does the S&P 500 actually return? The historical annualized return of the S&P 500, including dividends reinvested over the long run, is approximately 10% per year before inflation. That number comes from over 90 years of market data tracked by sources including NYU Stern School of Business and Vanguard. After inflation, you're looking at around 7%. Let's use the pre-inflation number for now, 10%, and we'll deal with inflation for both investments at the end, because that's where a lot of comparisons cheat. $60,000 compounding at 10% for 20 years. Run that math. You land at just over $403,000. Jordan turned $60,000 into $403,000 without doing a single thing after year one. Now, let's add the fees, because they matter more than most people think. A low-cost index fund from Vanguard or Fidelity charges somewhere between 0.03% and 0.20% in annual expense ratios. On a $60,000 starting balance growing at 10%, even at 0.2% fees, you lose maybe $8,000 to $12,000 in total fees over 20 years. Basically negligible. Taxes: if Jordan holds in a taxable account, he pays capital gains tax when he sells. Long-term capital gains rates are 15% for most middle-income earners, 20% for high earners. His gain is approximately $343,000. At 15%, that's about $51,000 in taxes when he eventually sells. Net, after taxes, roughly $352,000. But here's where it gets really interesting, and this is the thing most real estate versus stocks comparisons completely ignore. If Jordan had put that money in a Roth IRA or maxed out his 401k with index funds, his gains could be entirely tax-free or tax-deferred. Real estate investors get tax advantages too, depreciation, 1031 exchanges, but the Roth IRA is one of the cleanest, most accessible tax shelters that exists, and the majority of people who could use it aren't fully using it. A 2023 study from Vanguard found that only 14% of eligible Americans maxed out their IRA contributions in any given year. 14%! Most people are leaving serious money on the table by not even using the tax-advantaged accounts that are available to them for free. So Jordan, with a Roth IRA, 10% returns, 20 years, walks away with $403,000 completely tax-free. No property tax bills, no maintenance emergencies, no difficult tenants, no mortgage stress. That's $403,000 versus Alex's $635,000. Real estate wins? In this scenario, yes, but by less than you think once you account for all the real costs. And crucially, Alex worked for it. Jordan didn't. Here's where I want to slow down and talk about something nobody in this debate ever talks about honestly: the hidden cost of time. Alex's real estate investment isn't passive. Owning a rental property, even one property, is a part-time job. You're screening tenants, handling lease renewals, dealing with maintenance requests, filing landlord taxes, tracking expenses, negotiating with contractors. Even at the low end, studies from the National Association of Realtors and Real Estate Investor surveys consistently estimate that landlords spend between 5 and 10 hours a month managing a single-family rental. That's 60 to 120 hours a year. Over 20 years, that's 1,200 to 2,400 hours of your life. At a modest $50 an hour value of your time, which frankly is conservative if you have any professional skills, that's $60,000 to $120,000 in labor, unpaid, that doesn't show up in the return calculation. Subtract that from Alex's $635,000, and suddenly we're looking at $515,000 to $575,000 versus Jordan's $403,000. Still ahead, but the gap is shrinking significantly. And this isn't even touching the emotional costs, the stress of a bad tenant who stops paying rent, the anxiety of carrying a mortgage on a property that sits vacant for 3 months, the sleepless nights when the water heater breaks in January and you can't find a plumber until Monday. None of that shows up in a spreadsheet. I'm not saying this to make real estate look bad. I'm saying it because people go into real estate thinking it's passive income, and it's not. Not at first, not usually, until you have a much larger portfolio and professional management in place. Jordan's investment is actually passive. He set it up, he forgot about it, he checked it once a year, he did nothing for 20 years and walked away with $403,000 after taxes. That's worth something that numbers alone don't capture. Now, let me throw a wrench into both calculations, because this is the part most people miss entirely. We've been comparing one rental property to one investment in an index fund. But what if Alex, instead of buying a $300,000 single-family rental, bought a small multifamily property, a duplex or a 4-unit building? This is where real estate gets genuinely powerful in a way that stocks simply can't replicate. With a duplex, Alex lives in one unit and rents out the other. Her rental income offsets most or all of her mortgage. She builds equity while essentially living for free or near free. She learns the landlord business on a small, manageable scale. And in most states, she qualifies for an FHA loan, as low as 3.5% down on a multifamily property, dramatically increasing her leverage. This strategy, called house hacking, is one of the most underutilized tools in the beginner investor's toolkit. According to a 2022 Bigger Pocket survey, investors who started with house hacking built their portfolio significantly faster than those who bought traditional single-family rentals. They had lower monthly costs, higher occupancy rates, and more cash flow from day one. And here's the thing about stocks that real estate investors always miss. You can also add leverage to equities. Not the same kind of leverage. Margin accounts are much riskier than fixed-rate mortgages, but through retirement accounts, employer matching programs, and tax-free compounding, you can dramatically amplify your stock returns in ways that most investors aren't doing. If Jordan gets a 100% employer 401k match on his contributions, which a significant number of companies offer, he's effectively doubling every dollar he invests before the market even does anything. That's leverage. Different kind, same principle. The point is, the real question isn't real estate or stocks. The real question is, are you using the best version of each strategy? Or are you doing the average, unconsidered version of one and comparing it to the optimized version of the other? Let's talk about risk, because this is where the conversation usually goes off the rails in both directions. Real estate bulls will tell you that property is safe because it's tangible. You can see it, you can touch it, it can't go to zero. And there's something psychologically true about that. Most people feel more secure owning a physical asset than a number on a screen. But let's be honest about what real estate risk actually looks like. In 2008 and 2009, U.S. home prices fell by an average of about 30% nationwide, with some markets like Phoenix, Las Vegas, and Miami dropping 50% or more, according to data from the Case-Shiller Home Price Index. People who had bought highly leveraged rental properties in 2006 and 2007 weren't just watching a number drop on a screen, they were making mortgage payments on assets worth less than their loan balance, with tenants defaulting on rent in a market that they couldn't sell without taking a catastrophic loss. Leverage amplifies gains. It also amplifies losses. This is the side of the real estate leverage story that the dinner table uncles never mention. The S&P 500 also dropped around 50% in 2008 and 2009, so both got hit. The difference is liquidity. Jordan could have, if he panicked and made a terrible decision, sold his fund at the bottom and recovered elsewhere. Alex couldn't get out without losing everything. Her asset was illiquid, leveraged, and generating negative cash flow in a down market. Real estate risk is concentrated. Stocks are diversified. An S&P 500 index fund owns pieces of 500 different companies across every industry in the economy. A single rental property is one asset in one city, dependent on one local job market, one neighborhood, and one set of tenants. If the factory that employs most of your tenants closes, your rental market collapses. Your index fund doesn't care what happens in your zip code. Neither of these is inherently better or worse. They are different risk profiles, and the right choice depends heavily on what kinds of risk you can actually handle, financially and psychologically. So after all of that, here's the honest answer nobody wants to give you because it doesn't make a clean YouTube thumbnail. The best investment is the one you actually execute well. That sounds like a cop-out. It's not. Let me explain exactly what I mean. If you buy a rental property in a market you don't understand, with a leverage ratio you can't sustain during a vacancy, managing tenants you're not equipped to deal with, in a neighborhood you chose based on price alone, you will underperform badly. The math won't save you from the execution failure. If you invest in stocks, but you panic and sell every time the market drops 15%, if you try to time the market, if you chase individual stocks based on Reddit threads, if you pull your money out to buy a car, you will underperform badly. The 10% historical return only applies to people who stay invested. A 2021 study by Dalbar, a financial services research firm, found that the average equity investor earned just 7.13% over the last 30 years, while the S&P 500 itself returned around 10.65% over the same period. That gap, nearly 3.5 percentage points, is almost entirely explained by investor behavior. People buy high, sell low, panic, chase. The market returned 10.65%. The people invested in it earned 7.13%. The difference is discipline. Real estate has its own version of this. The investor who overpays for a property because they fell in love with it. The one who doesn't screen tenants carefully and ends up with a 3-month eviction nightmare. The one who buys in a declining market because the price seemed like a deal. Execution failures. Not real estate's fault. The strategy is sound. The execution wasn't. Okay, you've been patient. Here's the actual usable framework. Choose real estate as your primary investment vehicle if you have the time and temperament to be a landlord, you have enough capital for a meaningful down payment plus a reserve fund for emergencies, ideally 6 months of mortgage payments, you live in or near a market with solid rental demand and reasonable price to rent ratios, and you want to actively build wealth rather than passively accumulate it. Real estate rewards people who treat it like a business. Choose stocks, specifically low-cost index funds, as your primary vehicle if you want genuinely passive wealth accumulation. You don't have the capital or credit profile for a rental property right now. You value liquidity and flexibility. You're earlier in your career and still optimizing your income side of the equation, or you simply don't want the responsibility of managing a physical asset. Stocks reward discipline and patience above everything else. And here's the thing. The answer for most people reading this isn't actually choose one. The most financially successful people I've ever studied do both. They invest consistently in index funds through tax-advantaged accounts, maxing their Roth IRA and 401k first, always, and then when they have enough capital and knowledge, they add real estate as a separate wealth-building vehicle. The Roth IRA and 401k come first. Every time. Not because stocks are better than real estate, but because the tax advantage on those accounts is so significant that passing them up to chase real estate returns first is almost always a mathematical mistake. $1 in a Roth IRA that grows to $5 over 20 years is entirely tax-free. $1 in a taxable brokerage or a rental property that does the same thing has tax friction the whole way. Eliminate the friction first. Max your Roth IRA. That's $7,000 a year in 2024 if you're under 50. Contribute enough to your 401k to at least capture the full employer match. That's a 50 to 100% immediate return on your investment before the market does anything. Then once those are covered, build toward a real estate down payment or expand your brokerage account, in that order. Look, I know this video didn't give you the clean, satisfying real estate wins or stocks win answer you might have been hoping for. And I genuinely think that's a good thing because the people who walk away from content like this with a simple answer and act on it without doing the real work, they're the ones who end up on the wrong side of those cautionary statistics. The real math is complicated. Both vehicles work. Both have risks. Both reward strategy and punish laziness. The question isn't which is objectively better. The question is which is better for you at your current level of capital, knowledge, time, and risk tolerance. And now you have the framework to actually answer that question. Here's what I want you to do this week. Before you look at any property listings or open any brokerage apps, sit down and answer 3 questions. 1, do you currently have a Roth IRA? If not, open one this week. Seriously. Go to Vanguard or Fidelity, open an account, and put whatever you can in it, even $500. Start the clock. 2, are you getting your full employer 401k match? If not, adjust your contribution percentage today. That match is free money. Leaving it on the table is one of the most expensive mistakes you can make. 3, if you're genuinely interested in real estate, spend the next 30 days studying one specific local market. Not markets in general, one market. Learn the price to rent ratios. Learn the vacancy rates. Learn what neighborhoods are growing. Real estate knowledge is hyper-local, and the investors who win are the ones who know their market better than anyone else. Do those 3 things, then come back and watch the next video, because we're going to get into the specific numbers behind house hacking, and I think it might be the most underrated wealth building strategy most people have never seriously considered. If this broke down something you've been confused about for a while, share it. Send it to the friend who's been arguing for one side without running the math, because that conversation will be a lot more productive after watching this. I'll see you in the next one.